Well, welcome everyone. If you're here for the Cedarstone quarterly webinar, you're in the right place. We're going to begin in just a couple of minutes as I see just a few people continuing to join. This session will be recorded. As a quick reminder, we've begun the quarterly webinars in lieu of our annual seminar. And so I hope this is a great format for you all. One of the things that Carol and I both were pretty excited about, especially for this week and also last quarter, we're able to be much more responsive and address current issues by doing webinars quarterly. So for this webinar, we will be addressing the One Beautiful Bill Act. That is the act that was just passed on July 4th. A couple of housekeeping items as we let people join. First, we will be having a Q&A time at the end of the webinar. So if you have questions, please feel free to go ahead and put the question in the Q&A. There's a menu on your Zoom screen. It should show Q&A. If you click that button, you'll be able to type your question. We'll be able to see it and then address that question for you at the end of the session. We will also be recording this webinar. So if you have anyone that you'd like to forward this to, check back on the website in the coming days, and we'll have this posted so you can forward this to your friends and family. All right, well, with that, let's begin. So our agenda for today is to discuss the market. I do want to spend the first 10-15 minutes here just giving you all a quick update on what's happening in the market. And then the remainder of the session will be really related to the tax changes in the OBBBA. Before we begin, let me give you an important disclosure. So once again, this presentation does express the views of Cedarstone Advisors personnel, and there's no guarantee that our views are accurate. These are our opinions, and they may ultimately prove to be wrong. And this presentation has not been submitted to FINRA or the SEC for review or approval. I will highlight for you in this session, as it relates to the One Big Beautiful Bill Act, some of the information is still preliminary, and we are waiting for final regulations. The law is final, but regulations are forthcoming from the IRS. This information is our best understanding at this point from informed sources. Well, with that, let me begin with a quick market update. You may recall that the last time we spoke was in April, right about here, when Trump had just announced the tariffs, and the market reacted very negatively. I'm sure you all remember that vividly. At that time, we reviewed the tariffs, and one of our recommendations and thoughts in that situation was that it was likely that this was an opening salvo in a negotiation, and that the tariffs would ultimately not be as significant as announced. And that appears to have taken place. The market did obviously react very negatively to the tariff announcement, but then it has really done a V-shaped recovery and is hitting new highs as some of the tariff turmoil is receding. Somewhat ironically, the tariffs are hitting an average of about 10%, which is at 100-year highs. But the market is so relieved that it's not at the 30, 40, and sometimes 90% that was originally announced, that there's been quite a relief rally up to the point where we're hitting new highs on the S&P 500. Something that a lot of people have missed is that international markets have actually done better than the S&P 500 this year. This is the German stock market, the DAX, and you can see a similar flow where the German stock market was also impacted by the tariffs. But when we measure the year-to-date growth here, the German stock market is up actually 20% on the year, one of the best performing markets in the world, as some of the money is flowing outside of the US, somewhat in fear of getting out of the fear of the tariffs. Taking a look at the bond market, we are really seeing the bond market in a trading range. You can kind of see it here. So, during 2025, we did hit 4.8, but it's basically been in this trading range of 4.8 to 4, really more narrowly of late in the 4.25 to 4.75 range. That's a good thing. We're looking for a little bit more predictability in the bond market. We like to see that. And basically, with this is the 10-year rate on the US Treasuries. So with this as a benchmark rate at 4.6, 4.5%, corporate bond yields are hitting 5.5 to 6 for high quality bonds. And so we're seeing good yields coming out of the bond market, and we're excited to see that. This is a chart on gold, which I've included here because we did add a little bit of gold to the portfolio. You'll notice that there was quite a run up on gold at the beginning of the year, and that has now stalled. We are expecting gold to continue to rally through the year. If we look at the longer term trend on gold, it appears to be in a channel. We believe that this is a secular trend and that gold should continue to grind higher. It may stall out for the rest of the summer, but we are expecting it to grind higher in the fall and into 2026. Well, with that as a market update, let me shift gears and just give you a quick summary then. So I would summarize the markets to say markets have fully recovered from tariff turmoil. Tariff risks do still remain. The economy and earnings continue to show strength, and the market is grinding higher on that strength. Inflation remains subdued, and so we're fairly optimistic that stocks should grind higher between now and the end of the year, so that we should see stocks higher by year end than they are today. All right, let's discuss the one big beautiful budget act. Well, first, for those of you who don't know, what is it? So the OBBBA, as it's colloquially called here, was a comprehensive budget bill that was passed on July 4th. And now it includes more than about 70 changes to the tax laws that will impact individuals, seniors, and businesses. We're not going to go over all 70. Matter of fact, there's lots of information out there on the internet about this bill. It can be dizzying. So our goal was to really focus in on those most significant changes and the ones that we perceived as most impactful to our clients. The idea was behind the bill is that it's targeted at lowering taxes for working families and seniors. And so I think there's some good news in the bill, and we'll walk through those. So there's really 4 items that we want to walk through with you. The first is that the tax rates aren't lower, but there are the lower rates that were made permanent. I'll walk through what that means. There's something new called a senior deduction, and Carol's going to walk us through that. There's quite a bit of bad information out there on the internet. Some people are calling this the no tax on Social Security. That's kind of a misnomer there, and we'll walk through why people are saying that. There is a change to the state and local tax deduction. We'll walk through that. And then something that I actually honestly didn't think would happen. There is a provision that with very clear limits that there is no tax on overtime, but we want to walk through those limits so that you guys are clear on what that really means. All right, so let's walk through this. I'm going to start us off just walking through the rates. So when it comes to the tax rates, it's somewhat boring from the perspective that the rates aren't changing. But it's really good news. It's probably better news than I think most people realize. Um, the current rates, the rates that we've been using really since 2017, were passed under the Tax Cut and Job Act, actually in Trump's first term. And those rates were one of the most significant tax reductions, tax cuts in history. And so it was back then, back in 2017, this was a big deal, and I think really saved a lot of folks some money. Those cuts were scheduled to sunset in 2026. And so without any tax law changes, we would have reverted back to those 2016, pre-2017 tax rates. And you can see them here. So you'll see um, the 15%, what was 15% pre-tax cut is now 12. What was 25 is 22. What was 28 is 24. So really across the board cuts that were significant. The top rate was cut from 39.6 to 37. These rates over here in red are now the permanent rates going forward. And that's good news. I think it's good news. If nothing else, it gives us a lot more certainty for tax planning. And it's certainly nice that they are lower rates than really we've seen historically. So, what are the tax planning implications? Well, there's no significant changes, but it does remove a lot of the uncertainty for us because they're permanent. And as we go into year-end tax planning, we know now that 2025 and 2026 rates will be the same. We don't have to be shifting money between the years to game the rates. Remember, one of the most significant tax planning ideas that we can give you is to simply make the best use of the brackets. And so what this means often is shifting income in order to move money from one bracket to another, sometimes by deferring or advancing income from one year to the other. All right. Well, with that, I'll hand it off to Carol to go through the new senior deduction.
All right. Thank you, Steve. Yeah, this is the one new feature in the tax law that I have had the most questions about from our clients. It's also the one I think has been the most confusing and misunderstood. So yeah, let's take a little deeper dive. First of all, this deduction, the senior deduction that you've been hearing so much about, applies only to taxpayers age 65 and older. And it is effective January 1st, 2025. So this current year. It's a deduction that's available whether you itemize or not. So if you take a standard deduction, you still are eligible to take this senior deduction. And the amount is $6,000 per person. So it is, if a married couple, both are 65 years or older, it's $12,000 deduction that you receive. And which is pretty substantial, and it's something you'll notice in your tax return and your overall taxes for 2025. But there is some limits, so you get the full benefit of this deduction if your adjusted gross income is $150,000 or less. If you're married filing jointly. For individuals, it's 75,000 or less. And then once your income starts nudging over those thresholds, it starts phasing out. So it's actually fully phased out in the next $100,000 of income for married filing jointly. So for married filing jointly, that's 250,000. If your income is 250,000 or more, you will not get this deduction at all. And half of that for individuals, 125. So depends, the benefit will depend on how much your overall income is, how much you receive on that. And we can look at this. So, okay, this confusion that we've had. So the actual taxation of Social Security has not changed at all. It is exactly as it has been. The confusion is based on, some proposals and conversations and just misunderstandings in general. But it under the old and new law, because there's no change in this, for most folks, you are taxed for federal purposes at 85% of your total Social Security benefit. For some folks with lower incomes, that percentage may be lower, but most of our clients going to fall in this 85% category. So, if your Social Security benefit, just for sake of example, was $1,000, you're really only taxed on $850 of it. And that's for federal purposes. There's no tax on state. But I think the confusion comes when what people are talking about is, why do people say there's no tax on Social Security? Because there really has been no change on the taxation, but the conversations have been, okay, you guys get a standard deduction, and actually if both husband and wife are 65 or older, that standard deduction in 2025 is $35,400. So you get that as a standard deduction, plus this $12,000. So that is $47,400. So most people's Social Security falls beneath that. So in a sense, if you have Social Security of $47,000 and you get the standard deduction plus the senior deduction, that kind of cancels that out, if you will. So I think that's where, people claim there's no tax on Social Security when in fact taxation on it has not changed at all. So just this awesome deduction. And this is a great example, I think, that can really explain it a little better. So the current law we had up until July 4, when this new law was signed, we had, in this example, a couple who's both 65 with adjusted gross income of $200,000. They get a regular standard deduction of $31,500. They get a little, even under, the previous law, the little bonus in their standard deduction of $3,900. So that's a total of $35,400 deduction right there. So 200,000 gross income, deduct 35,400, and then that gives you a number that's your taxable income. Under the new law, same example, $200,000 of income, husband and wife are both 65, the same standard deduction, the same extra deduction for being 65 or older, but now we have a new $12,000 deduction, $6,000 for each of them because they're both 65 and older. So the total deduction now is $47,400. So that's, pretty substantial deduction from taxable income. I think, you'll feel that in when you do your taxes, you'll notice that this year.
So Carol, does that
Yeah.
mean the first $47,400 of income is basically tax-free in essence, correct?
Yes. Okay. Yes. So good point. Yeah. Yeah, exactly. So that is where some of the confusion may have really come from with Social Security. If part of your 200, well, your 200, part of your $200,000 um, income up at the top includes your Social Security, and most people are under, 40,000, certainly under 45,000. You're offsetting all your Social Security income with this $47,400 deduction. I mean, is that what you're, yeah, yeah,
Yeah, yeah.
sure,
I just wanted to clarify that. Yeah,
yeah, yeah.
pretty nice.
So that is why people are claiming that. So, you've had for years now the deduction at a total of $35,400, but now with this additional 12,000, it's 47,400, which is going to completely offset your Social Security income in total. All right. So planning, we think about tax planning a lot when we're you know, looking at your financial plan. And so here's some things related to this new senior deduction. Steve was talking and showed you all the different tax brackets. So really powerful consideration when we're doing tax planning is managing those tax brackets and where your income falls. So, for example, if we're considering a Roth conversion, that adds taxable income in the year that you do the Roth conversion, that bumps your income higher. So we are already doing this. We're already looking at how that impacts the senior deduction. Will that reduce your senior deduction? Will it eliminate your senior deduction? Is it worth, the cost worth the benefit? We're watching that very closely. And another example might be, um, for retirees who are taking draws from their traditional IRA accounts. You have an emergency need, and taking an extra draw bumps your income up. But maybe we can take that extra need from another bucket. If you have a savings account, a taxable account, a Roth account. So just managing the bracket that you're in and not allowing additional income to bump you into higher brackets. So and then lose the senior deduction. So we're watching that. The other thing I think is definitely worth thinking about, this senior deduction is temporary. So we'll have it for a few years through 2028, the way it's written right now. This you're going to see, it'll impact your cash flow because it will save you real deal tax dollars, and you'll notice it. And that is an improvement, gives you a little more spending freedom for a time. So, as you think about the next few years, you'll have a little um, bump in cash flow, and it is temporary. So, keep that in mind too. But it is a nice opportunity and a great new tax benefit to seniors. Yeah.
All right. Well then, you, Carol, I will, let me cover the state and local tax deduction. So one of the changes in the OBBA is a change to the limitation, the limit of deductibility of what's called the SALT deduction, state and local tax. So let me give you some groundwork here before we talk about what the change is. So first, well, what is the state and local tax deduction? It's basically an itemized deduction that allows you to deduct the state and local taxes that you paid if you itemize, right? So it counts towards your itemized deductions normally. Now, as part of the Tax Cut and Job Act in 2017, the the Tax Cut and Job Act did limit the state and local taxes that you can deduct to a maximum of $10,000. So, if you paid, and Californians, right, we're likely paying much more than $10,000. So if you paid a total of $30,000 in California state income taxes and California property taxes, it doesn't matter. The maximum under the old law was $10,000 per year. Now, the good news is that the new rules have increased the limit to $20,000 for individuals and $40,000 for married foreign filing jointly. So pretty significant increase that should help us out, particularly here in California. So let me walk through what this might look like. Okay, so again, this is just an example of maybe a typical tax return. This may not look like yours, but this might be a helpful exercise to be able to see how this might work. So under the current law, let's assume we have a taxpayer that has income of $200,000. And this individual had a mortgage interest of about $15,000. That's an itemized deduction. This individual had charitable contributions of $6,000. That's an itemized deduction. This individual had $15,000 of California income tax and about $7,000 worth of California property tax for a total state and local tax of $22,000. But as I said, that was limited under the current law to $10,000. And so the deduction is the smaller of those two numbers. It's limited to 10,000. So if we add up all of these deductions in my example here, even though this individual had some pretty significant expenses, the total of those totals $31,000. And therefore, this individual actually wouldn't end up itemizing. They would just take or actually, this would be a married couple. The married couple would just take the $31,500 standard deduction, and really, in large part, because of the limitation of the state and local tax. So let's look at how this scenario might change under the new OBBBA rules. So again, same situation, $200,000 of income, $15,000 mortgage deduction, $6,000 worth of charitable contributions. Same California income tax and property taxes paid for a total of $22,000. But now the limitation has been raised to $40,000 because our 22,000 of actual payments is less than the $40,000 limitation. We get to deduct the full $22,000. Now our total itemized deductions, including the mortgage and the charitable contributions, is $43,000, which is a significant increase to our itemized deductions compared to what we saw previously. This is actually, I think there are actually millions of taxpayers that will be in a similar situation here. I think this is not unusual at all. And so, what are the planning implications here? Well, I mean, one of the most significant planning implications is you're much more likely to itemize deductions under the new SALT deduction limit. And that is important to consider. That's actually something that you may want to think about for 2025, because the way that this worked previously, because of the state and local tax limitation, you may have been making charitable contributions and not receiving any benefit, just like our example here. So, for example, this $6,000 of charitable contributions did not matter at all in this example. Under the new rules, it certainly did matter. And that's a significant change. Even though there wasn't any change to charitable contribution rules, the state and local tax change did make it much more likely to itemize, and so much more likely that your charitable contributions will matter, as well as your mortgage interest. And so something to think about. And overall, we would expect this to lower the overall tax liability. Um, and so, from that perspective, it's good news. All right, Carol, do you want to walk us through the final one, which is no tax on overtime? You're muted, Carol.
Yep, pardon me. Sorry about that. Yeah, I just before I dive in on this, I did want to say if you guys have any questions as we're going along and want to type them in the chat, when we're done, we'll address those questions. So feel free to go ahead and do that. You should be able to see a chat option on the bottom of your Zoom screen. So this is big for many of our clients. What I'm about to talk about here. Um, the feature in the new tax law regarding overtime. And first question here really, what is considered overtime? And that is if you are an hourly employee, that would be anything in excess of 40 hours per week is considered overtime. And a really big, I'm going to say caveat here on this particular feature in the new law is that overtime, what it appears right now is that what is considered eligible overtime is the premium part of the overtime. So let me just give you an example. If you're an hourly employee who makes $30 an hour and you work 1 hour of overtime at 1.5 times pay, that hour is paid to you at $45 an hour. So 1.5 times pay. So the $15 that is above and beyond your normal $30 hourly rate, that $15 is the premium pay. It looks like, we're so new on this, not even quite 2 weeks into this new tax law, that there is going to be much, like Steve mentioned, we're going to be getting more guidance on this. This is an area that we are anticipating more clarity, but it does appear it will just be related to the premium pay. So that extra, in the example I gave, the extra $15 in the hour. So it's a little different than you might be thinking, but still, this is pretty amazing feature in the new tax law. So the other feature about it, it's your wages will all be reported much like they have in the past. Gross wages for reported on a W-2. The overtime, the premium pay, the portion of your gross wages that is due to the premium overtime is going to be a deduction. So you'll still have, report your full annual wages, which includes all your overtime, but you will get a deduction for the premium overtime pay. This applies, this law is effective January 1st, 2025. So it's retroactive really from when it was signed into law here on January 4th. July 4th. So this is also something we'll talk about as we go on. But the other thing that you should know is just that we talked about this, but it will be somewhere unknown on your tax return as a deduction. Clarity on how that's going to look on your 2025 tax return has not yet been determined, but a deduction, like I mentioned, and it applies, again, I'm just going to emphasize, to hourly employees. So if you're an exempt employee and you're paid a salary, this does not apply to you. You have to be a non-exempt employee, and which is, we typically refer to that as just being an hourly, you're paid hourly. So the deduction is going to be $12,500 per year as a maximum for a single taxpayer, and $25,000 if you're married filing joint. So you might some of our clients have substantial overtime pay, and this is going to be limited. This is going to limit them. So just keep that in mind. It's not all overtime, and it is also a temporary provision in the tax law. So we have a few years of this through 2028 to take advantage of this. Another limitation that is written in the tax law is that it does start phasing out for incomes for individuals that are over $150,000 and $300,000 for married filing joint. So there's definitely some pretty significant limitations on that, but for those that qualify, it's very, very big benefit. I think we have an example on, yeah. I think it helps to see an example. So let's just look at, this is for a single taxpayer. Single taxpayer has $60,000 of base wage income plus $12,000 of premium overtime pay. That is $72,000. So in this example, this individual will have a W-2 that reflects the full $72,000. Then they get their standard deduction, $14,600 for an individual, no additional deductions under the law prior to OBBBA. So taxable income is $57,400 for this person, with an estimated federal tax of $87.45. Under the new tax law, as it relates to this scenario with this individual, same income, total income 72,000, same standard deduction, but now their premium overtime pay is an additional deduction. So in addition to their standard deduction, they get this extra $12,000, which means now their taxable income is lower. It's at $45,400 with an estimated tax on that at a 6405. They're saving, in this example, $2,340 of tax just by eliminating the $12,000 of overtime, premium overtime pay. In a scenario where there's a married filing joint couple kind of at the top, getting close to $300,000 of income, in that tax bracket for married filing joint, their deduction, as I mentioned, $25,000. That in their tax bracket would save $6,000 in taxes. So depending on what your income is and your tax bracket, this could be a pretty big windfall as far as actual tax dollars. So yeah. All right. So as far as planning implications and what this means, I mean, overall, this is going to lower your tax liability for those of you who are eligible to take advantage of it, who have premium overtime pay. Like I mentioned, for some people, up to $6,000 of tax dollars saved. So it provides an opportunity to use that income to increase your retirement savings. So you can bump up your 401k contributions or your IRA contributions or your backdoor Roth contributions. So it is temporary. So it's kind of a temporary windfall for a few years. And that's a great way to take advantage of that without any change in lifestyle. The other thing to think about, this is going to be significant for 2025, is that this is retroactive all the way to January 1st. So many of you have already had withholdings on your overtime wages already. We're here, mid-July here. You've had substantial withholdings. So you will, without any adjustments to your withholdings going forward, will likely have either a bigger refund or you'll owe less money, but it will impact your taxes because you have already, in a sense, over withheld taxes on your overtime pay. Which, that you could feel that come tax time when you get a bigger refund. It depends on your tax particulars, but yeah, that's a really great benefit if you qualify. Mm,
Very good.
yeah.
Well, with that, thank you, Carol. With that, let me go ahead and just raise a couple of questions that people have submitted for us. So first, on the salt deduction, the question is, the salt deductions, is this only for the next few years, or is this a permanent thing? And
Yeah.
so I guess I can answer that, I guess. So this does phase out. So first, it is indexed for inflation. So it does go up for 26, 27, 28, and 29. Beginning in 2030, the salt deduction is scheduled to go back to the $10,000. So we'll see how this goes, but it is limited. So great question on that.
Yeah.
And then for clarity, the second question is for clarity, these tax deductions, the $6,000, I assume that means the senior deduction, and the
Mhm.
all start January 1, 2026. The 2025 year earnings will be the old system. So Carol, do you want to take that for the senior deduction?
Yes, okay. Let me just double check something here. What I show is that it's effective this year, but 2026 will be the first year of an inflation adjustment on that, meaning it will be bumped up in 2026 a little bit.
Yeah,
So
yeah.
that so those of you that qualify will get that bonus in 2025. So you've already got it if you're qualified. You meet the income limitations and the age restrictions. You've got this for 2025. So you will feel it. If you don't make any other adjustments to how you pay taxes, you
Mhm.
will feel it when your tax return is prepared and the final outcome of that.
Yeah, yeah, very good. Yeah, so I think then the answer is on both the senior deduction and the state and local tax limitation. That is effective in effective 2025. So that's going to impact this current tax year.
Yeah. Yeah.
Um, so the next question is, would a bonus fall under overtime? You want to take that one, Carol?
Well, that's such a good question because, wow, I don't actually know the answer to that. I mean,
Yeah, we
if
we
I
kick
was
this
going to
around
make an
quite
edu,
a
yeah,
bit.
I didn't see that specific question addressed in my research and in the resources from the American Institute of Certified Public Accountants. Um, But bonuses, I mean, you can pipe in on this too, Steve, but bonuses are paid typically whether you're hourly or salary exempt or non-exempt. So if I was going to make an educated guess, I would say that is not going to qualify. But Steve, what are your thoughts on
Yeah,
that?
I mean, I would agree. I think, that does fall into the category of, I think we're going to have to wait for the regulations to come out from the IRS. The way this process normally works is that Congress passes laws, and then the IRS sometimes has to pass regulations that clarify their interpretation, and those interpretations can be challenged, but their interpretation of the law. And so um, I would agree with Carol. I think that bonuses, based on my reading would likely not qualify as overtime. It's really targeted at those hourly employees, and just the way that the terminology is phrased, it's in excess of a 40-hour work week, right? So
Yeah,
it's
yeah,
not a bonus based on performance. It's not an end of year. It's the idea on this no tax on overtime is it's based on hours worked in excess of 40 hours and you're paid hourly, I think is the way that,
Yeah,
that's going to be interpreted. So
that's
great
a good
question.
question. Yeah.
Very good. All right. Well, those are all the questions that we have at this point. And so, and we actually came in a little bit under time, so we'll wrap up here. Thank you once again for joining us. We're looking forward to these quarterly webinars, and I hope that you find these helpful. Certainly, we would welcome your feedback, positive or negative. Also, we would welcome topics that you'd like for us to discuss on our quarterly webinars. Again, we're using this as a replacement for our annual meetings. And I think the benefit is we're able to maybe do a little bit more bite-sized pieces, be a little bit more timely on some of these current issues, and hopefully keep you informed on what's going on, both in terms of the market and some planning items. So thank you all. We appreciate you and talk to you soon.
Yeah, thank you.